24, only been with one man. What happened to her plan? She was gonna be an actress, she was gonna be a star, she was gonna shake her ass on the hood of Whitesnake's car. Her yellow SUV is now the enemy. Looks at her average life and nothing has been alright. Since Bruce Springsteen, Madonna, way before Nirvana, there was U2 and Blondie.
Welcome back to the final showcase session of the conference titled Benchmark Your Bank's Credit Risk Performance Against Peers. During this session, our presenters will explain how RMA's Credit Risk Navigator allows you to understand how your portfolio stacks up against other banks. Welcome.
Thank you, Jen, and I want to thank everybody for their time today. I'm here with Tom Cronin from AFS, and RMA and AFS are pleased to announce that we have relaunched the risk analysis service as the Credit Risk Navigator. The Navigator comes with a new, easier to use look, a reduced set of data requirements, and a more affordable price point. Today, I will start off by quickly reviewing the history of Credit Risk Navigator, and then we have Tom here to discuss some ways in which banks are using Credit Risk Navigator to enhance their portfolio management. Credit Risk Navigator was established in 2003 as the risk analysis service with $200 billion in exposure and roughly 100,000 loans. 18 years later, Credit Risk Navigator now has $1 trillion in exposure and almost 1 million loans included. So how does Credit Risk Navigator work? Banks send their data into AFS every month, so data is available on a monthly rather than a quarterly or annual basis. The submissions contain performance and credit quality information and can be further segmented by factors such as industry, geography, and deal size. Banks are then able to use their individual dashboards to compare their results versus a select group of peers and the overall market. Next, Tom is going to answer a few questions and both explain and show us how some of our current subscribers use Credit Risk Navigator. So Tom, the first question I have today could come from anyone in a bank, from the chief credit officer to the head of business banking. What is my bank's exposure to and experience with the industries that have been most impacted by the pandemic interruption? Is my bank's performance worse or better than the market, particularly as it relates to hotels, retail, and arts, entertainment, and recreation?
So Carly, as you've cited, the CRN data has shown that most of the pandemic's impact has been limited to a few sectors, and hotels, retail, arts, entertainment, and recreation have been the hardest hit. And we can use the Navigator to see how the demo bank here is doing versus its peers and the market. But first, let me give you a quick orientation of the Credit Risk Navigator. So it has 3 web pages. Up here at the top, there's the executive summary, the early warning problem loan management, and the concentrations tab. To answer your question, I'm going to look at the executive summary, and we're going to look at non-accruing. Pardon me. So there are 5 tiles across the top for non-accruing. Utilize exposure, past due, 5 tiles for executive summary. Utilize exposure, past due, non-accruing, weighted average probability default, and low pass. There's a large trend chart in the middle, and you can see this goes back to 2003, as Carly had mentioned coming on. So it gives you the data through the Great Recession and the energy crisis, and now through the pandemic interruption. And then there are 3 smaller charts at the bottom that show the more recent history for the bank versus the peer group. And this is a selected peer group. Each bank gets to select their own group of peers, and then the entire market. So let's start answering Carly's question. And so non-accruing for this bank is 0.54%. And for the market, by going over to the side, we can see it's 0.81. So overall, the demo bank is performing better than the market. But we want to look at the individual sectors. And the first one we're going to look at is the hotel sector. And so I'll go into the industry filter, come down to 722 NAICS code, and then pick accommodation. And as I click on this, you'll see that the non-accruing changes. And so now for the bank, the non-accruing rate is 1.29%. Remember, it was 0.54 for overall average. So your non-accruals, if this was your bank, your non-accruing is not doing well. And if we look on the big chart at the far right side, you can see the market is at 0.58 for hotels. So the market is doing much better than you are. You're not only above the market, but you're also way above your individual bank's rate. So this would be an area where you would want to take a look at and maybe begin to de-risk yourself of some of these loans. The other second market that we had talked about, second factor, was retail. And when we say retail here, we're talking about things such as bookstores, department stores, sporting goods stores, things like that, as opposed to motor vehicle, new car dealers. And so now I've pulled up 45 retail, and you can see that it's changed, and the bank is at 168. Again, the bank average is 0.54, so you're way above your average, almost 3 times above it. And if you look at the market's at 152. The market's doing poorly also, so definitely a very risky industry here. And the bank is doing worse than the market. So another area where that's been hit hard by the pandemic, and your bank's results have been less than stellar as well. The last one we want to look at is the broad area called arts, entertainment, and recreation. And this industry, again, a very broad industry, deals with things such as museums, theaters, fitness centers, all those industries that right out of the bat were shut down because people didn't want to get together in closed areas. And you can see the bank, your bank results again are 1.39%, way above your average. You're not doing as bad as the market, however. The market is up at 2.48%. So you're doing okay when you compare yourself to the market, but not okay with compare yourself to the rest of the portfolio. So this is another industry where at a minimum, you would want to at least hold steady with what you're doing. So Carly, I'll turn it back to you.
Thank you, Tom. While some banks are able to get data on metrics such as percent non-accruing, it certainly doesn't have the level of detail that Credit Risk Navigator has. On to the next question. As my bank's chief credit officer, how am I ensuring that our portfolio does not have any significant concentrations in segments that are underperforming?
So let's jump over to the concentrations webpage first, and then we're going to go to a different webpage after this. But we want to see what the portfolio mix tells us right off the bat. And we're going to focus on industries where the demo bank has a larger percentage of its loans versus the market, sectors, if you will, that are over concentrated and are considered risky, because we know that the rating agencies will downgrade a bank a notch or two if you're over concentrated in a stressed industry. So if we look at the chart down here for industry, again, this is industry concentrations. The chart at the bottom shows you the top 10 for your bank. And you can see that above market average concentrations are seen for 52 finance and insurance, 62 healthcare, and then further over to the right, 11 ag, forestry, fishing. So we have an idea now of where we're over concentrated. So what we need to do is determine whether or not these industries are underperforming. So to do that, I'm going to go to the early warning problem loan management tab in the middle. So similar to what you saw with the executive summary, this particular web page has tiles across the top for various measures, the performance measures of past due and non-accruing on the ends, line of credit utilization, and criticized loans, a credit quality measure in the middle. Each one of those tiles has a gauge right below it. And those gauges are color coded based on the 18-year history, performance history of those various measures. So red, like if you see for line of credit utilization, red would mean that this is the highest it's ever been during the last 18 years. Green is the lowest, yellow is right in the middle. There are 4 charts that accompany this web page. The first one in the upper left gives you the dollars for whatever measure you've selected. The one next to that on the right gives you the percentages. And then down below on the lower left is the worst performing industries. And again, this is your top 10 industries. And then the worst performing geographies. And again, the top 10. So we're looking at past dues, and the demo bank is 0.65. And if we come over to the chart on the upper right, we see the market is 0.50. So on a general basis, the bank is a little bit worse than the market. But we wanted to go look at those industries that were concentrated. And the first one, if you remember, was 52, finance. So again, I'm going to go into the industry filter, select 52, finance and insurance, and you'll be able to see in a second that it changes. And so for the bank, the past due is 0.16, so much better than the bank average. And as you can see from the chart on the upper right, the market is at 119, the bank is at 0.16. So what that tells you is the bank's portfolio is doing well, but overall the industry is at stress. So this would be an industry where you wanted to monitor any additional loans and maintain, at a minimum, maintain your credit quality standards. So let's go look at the next one, 62, which is hospitals, healthcare, doctors, things like that. And if you select 62, and again, we'll see the past dues in the upper left change. And now we have quite a different story from what we saw with 52. So here, the bank's past dues are at 2.95%. And you can see it's the highest it's ever been. And again, I'm looking at the upper right-hand chart. It's the highest it's ever been in the survey's history, at 295. The market's at 0.79. So the market's a little bit higher than average, but your bank's results are actually worse than it's ever been. So clearly this would be an area where you'd want to reduce exposure because if the regulators or rating agencies saw this, it would not be favorable. The last one where you had a concentration was agriculture. And luckily that's right up top. So we'll apply that. And you can see from a bank standpoint, your portfolio is doing pretty well. You're at 0.4% past due. And again, there are various charts to look at. I'm looking in the chart in the upper right. So you're at 0.4. The market, however, is at 129. So the market is almost 2.5 times what it normally is. So here again, it's an indication that you're concentrated in an industry where, although you're doing well, the market and this industry as a total or as a whole tends to not do well. So you might want to watch out what you're doing here. So Carly, I'll turn it back to you again.
Those are some fantastic insights, Tom. Super important for banks looking to better predict and proactively manage problematic segments. Finally, this last question comes with a bit more of a specific angle. Let's say my bank is thinking of expanding into the Southeast, specifically Florida or Georgia. What states and cities are doing well, and where should we expand to in order not to compromise our credit quality?
So Carly, to answer that, we're going to go back again here to our early warning problem loan management. And since we're talking about credit quality, we want to switch this to look at criticized loans. And in the Credit Risk Navigator, criticized loans are loans that would be risk rated special mention, substandard, doubtful, or loss. And that's based on the RMA 10-point scale. So these are loans in the 7, 8, 9, 10 range. 1 through 6 is passed, 7, 8, 9, 10 are percent criticized. And this gives you an idea of the quality of the loans that are in the various regions and sectors. So we want to look at Florida pardon me, and Georgia. So let's first go in and look at Florida. And in the Credit Risk Navigator, we have the ability to look at loans at the state level, a regional level, a state level, or the CBSA, which is the core-based statistical area. Another word that you'll typically hear is MSA, Metropolitan Statistical Area. But let's look at CBSAs. So we'll go in, we'll look at USA, and let's scroll down and get Florida. And see, again, this is looking at the percent criticized for Florida. And you'll see the chart changed. And now the number that you see, the 21% criticized, so that's for your bank, but you remember your bank doesn't have much exposure here. So we really want to ignore that number. Let's instead focus on this chart on the upper right side and the market number. So the market number is 849. If you remember the market all-in number, which I should have showed you before, but I didn't, is 597. So Florida is a little above average, the national average. So maybe you want to look at this, maybe you don't. So let's go take a look at Georgia to see if Georgia's any better. So again, we'll go up to our CBSA chart. We're going to go down and pick Georgia and just the cities that are within the main part of Georgia. And again, so you see the 16% for the bank, not much outstanding. So that number isn't really worth looking at. But what is worth looking at is the market number at 5.04%. If you remember, the all-in market number is 597. So Georgia is below average and much better than Florida. So Georgia would probably be an area that you'd want to look at. And then within Georgia, one of the things you have the capability of doing is to go look at various cities within there. So let's take a look. So we'll open Georgia. Let's say we want to look at Atlanta versus Savannah. And first I'm going to clear this because I think I have something stuck. So here we go. So here's Atlanta. And you can see how easy it is to move these in and out and clear things that you don't like. So we go to Atlanta. We see that, and again, let's just look at the market. It's at 4.98%, even lower than what the overall average is. So Atlanta looks good. What does Savannah look like? So we'll go into Savannah. We'll clear to make sure we're doing it right. We'll go down to Savannah, select Savannah, hit apply, and then we come back. And again, we're looking at just the market. And Savannah's at 933, so almost double what we saw in Atlanta. So to answer your question then specifically, Carly, what you would want to do if this was your bank and you're looking going into the Southeast, you would want to go into Georgia and into the Atlanta metro area and stay away from Florida. So that's turns it back to you, Carly.
Thanks, Tom. It's great to see that not only can you filter by industry or segment, but you're also able to drill down into details such as geography, loan size, and type of loan or collateral. That's definitely not something you can get from a simple bank call report. Thank you to everyone for participating today, and a big thank you to Tom for helping us understand more about how banks are leveraging Credit Risk Navigator to further understand and manage their overall risk. If you are interested in learning more, please reach out to myself or Tom, or you can visit rmahq.org/Credit Risk Navigator to get more information.
Thank you. And thanks to all of you for joining us for these important showcase sessions. Now, we will take a short break. The plenary session featuring Charlie Scharf, President and CEO of Wells Fargo, will begin promptly at 1 p.m. See you then.
All the leaves are brown. California, stopped into a church. I passed along the way. Well, I got down on my knees, and I pretend to pray. You know the preacher like to call. He knows I'm gonna stay. You've been running around, throwing that dirt all on my name. 'Cause you knew that I'd call you up. You've been going around every party in LA. 'Cause you knew that I'd be at one. Oh, I know that dress is karma, perfume regret. You got me thinking about when you were mine. Now I'm all up on you, what you expect. But you're not coming home with me tonight. You just want attention, you don't want my heart. Maybe you just hate the thought of me with someone new. Yeah, you just want attention, I knew from the start. You're just making sure I'm never getting over you. You've been running around throwing that dirt all on my name. 'Cause you knew that I'd call you up. Baby, now that we're right here standing face to face, you already know that you won. Oh, I know that dress is karma, you regret. You got me thinking about when you were mine. You got me thinking about when you were mine. Now I'm all up on you. What you expect, oh, baby. But you're not coming home with me tonight. Oh, no. You just want attention, you don't want my heart. Maybe you just hate the thought of me with someone new. Yeah, you just want attention, I knew from the start. You're just making sure I'm never getting over you. What are you doing to me? What are you doing? What are you doing? What are you doing to me? What are you doing? What are you doing? What are you doing to me? What are you doing? What are you doing? What are you doing to me? What are you doing? I know that dress is karma, perfume regret. You got me thinking about when you were mine. And now I'm all up on you, what you expect. But you're not coming home with me tonight. You just want attention, you don't want my heart. Maybe you just hate the thought of me with someone new. Yeah, you just want attention, I knew from the start. You're just making time you come around, you know I can't say no. Every time the sun goes down, I let you take control. I can feel the paradise before my world implodes. And tonight had something wonderful. My bad habits lead to late nights, sitting alone, conversations with a stranger I barely know, swearing this will be the last, but it probably won't. I got nothing left to lose or use or do. My bad habits lead to white eyes staring into space, and I know I lose control of the things that I say. Yeah, I was looking for a way out, now I can't escape. Nothing happens after two. It's true, it's true. My bad habits lead to you. My bad habits lead to you. My bad habits lead to you. Every pure intention ends when the good times start.